Welcome to Transactional Flow. My name is Jeremy Charles. I will be the face that you'll have to deal with until you decide to unsubscribe. So better get used to it. So today we're going to be talking about something that we have not seen happen in I can't even tell you how long. So for those of you that don't know me, I'm Jeremy Charles. I'm a licensed real estate agent in South Florida. And right now I decided to make this video because we noticed that interest rates had dropped. And we haven't seen this happen since the end of last year, not even. We have not seen interest rates drop for so long that we started to believe that it's the norm. And so reason I'm making this video is because we want to know, is right now a good time to buy a house? Some of you are sitting on the fence, you're thinking maybe rates will go down a little bit lower. Maybe I can wait till the end of the year. It is an election year. I'm unsure. Whatever. We're going to break that down. We're going to figure it out right now. Is it worth buying a house right now in this economy? Okay. And so, reason I'm even making this video is because of the developing news that was taking place. So, as you know, we talked about it. Interest rates recently lowered. Now, what does that even mean? Well, the 10-year treasury note is what kind of dictates the interest rate within our economy. And the 10-year treasury note is dictated by the Federal Reserve. We hear about the Federal Reserve, we call them the Fed. They're the ones that are basically printing the money. They're the one that's increasing interest rates. They have those two powers within our economy. And so specifically with the 10-year treasury note, what is it anyway? It's basically a tool that they use to kind of entice investors to put money into our economy. So Beijing, China, they say, okay, Beijing, drop like $50 billion over here. We can guarantee you a 3.9% return on your money. Beijing is like, I don't think so. That's kind of weak. So what the Federal Reserve will do is they'll increase that yield. And when they increase that yield, they're trying to make it more enticing for investors to park their money. And it's not just international investors. We have local investors within the US. And what they want to do is they want you to feel confident to lock your money within what we call notes for 10 years. Now, some people won't do it because they're like, wait, anything can change in the next 2 to 3 years. It's an election year. Why would I lock my money at a 3.9% return when so much can go wrong right now with the fact that we're in war right now. We're at war. There's war taking place in the Middle East. We got that Russia situation still taking place with Ukraine. So a lot of investors are like, I think I'm gonna just kind of sit on the sideline for a little bit and warm up the bench. But at any rate, so the way that it works is once the 10-year Treasury note increases, interest rates increase. And I'll explain to you in the next slide right here. So if you're looking to buy a house or you're even thinking about the idea, if you're even flirting with the idea to the slightest and in the back of your mind, the first thing you want to do is you want to familiar with the economy. You need to know how the economy works. You need to know how interest rates work. You need to know all of that. And so, like we talked about, the 10-year treasury lowered to 3.940 as of yesterday, right? What does that even mean? It lowered, meaning that they're starting to have a little bit more confidence in the economy. Okay. And so the interest rate, the federal fund rate or the 10-year treasury, it dictates the rate for so many different other factors. Some people think it's just about buying a house, but it's not. When you're buying a car, it's predicated on that. When you're basically getting a credit card loan, it's predicated on that. You're getting a personal loan, it's predicated on that. You're looking to refinance, maybe you have your home. You can even refinance your car. It's predicated on that. So as a consumer, if you're thinking about buying a house, the first thing you want to do is you want to get familiar with interest rates or the 10-year treasury, okay? And so as we talked about, the Federal Reserve, they dictate what takes place with the interest rates indirectly because the interest rate is comprised of two factors. We got what is called the index. So just like you have the Dow Jones, you have the S&P 500. Those are all forms of what we call index, but plural is indices, right? And so what usually happens is they'll use that number from the index, and then investors or lenders they'll add their 2 to 3%, which is their margin on top of that to create the interest rate. So let's backtrack. So the index, there's so many different forms of indexes. But within the real estate industry, the most one that we usually use is the 10-year treasury. That kind of tells us where the economy stands, how the US economy is performing, and that usually tell you what your interest rates will be. So if the index is at 3.94%, you're going to add anywhere between 2 to 3%, depending on who the lender is, on top of that to come up with what we call the full rate. right? And so, for example, you go to the bank, one bank might say, hey, you give us your money, I can give you anywhere between a 3.5% return for the next however year. When you lock your money into a CD, it's the same concept. They tell you, hey, lock your money in for 2 to 3 years. We'll give you about a 3, 4, 5% return. Reason being is because the federal fund, I'm sorry, the 10-year treasury note, in addition to, well, technically it'd be the 10-year treasury bill, but anyway, that's a different topic. Anyway, so what happens is they add those two numbers together and you get what is called the interest rate. And so let's do some breakdown. Let's see if it makes sense to actually buy a house right now. Okay, we're going to be looking at the FHA because FHA is the most common one that most people traditionally use. So let's look at this example right here. So I live in, Palm Beach County, Florida. And let's look at this brand new construction, beautiful 3 bedrooms, 2 bathrooms, 1977 square feet home, right? You can see in the top left, you got that beautiful 2-story look. You got that nice 2-car garage. And then in the top right, you got that weirdly blue kitchen, nice stainless steel appliance, right? And then you got the, nice backyard in the back, of course. And you got the cheap carpets, the developers being a little cheap because it's cheaper to put carpet instead of some nice tiles. But hey, we're not judging. But anyway, the most important part though we want to look at is the HOA. The HOA fee is 298, and then we got taxes at 6420. Remember those two numbers. Okay, and the price of the home is 575,000. Okay, so this is the same exact property. Here's the price, 575,000. It's located in Loxahatchee, Florida. If you're not from Florida, Google it. Right section. Let's look at the numbers. Let's get down straight to the numbers. I'm a numbers guy, right? So we have this home right here at 575,000. You come out of pocket with 5%. Now keep in mind, your down payment is always optional. Well, technically, it's optional to a certain extent. So FHA, the least you can put down is 3.5%. Conventional, you might get away with 3.5%, but traditionally it's about 5%, right? But anyway, the more money you put down, obviously, the lower your payments will be. But let's backtrack a little bit. So you have this house right here, $575,000. You put 28 bands down as your down payment. You're getting a loan amount of 546,250. The most important part when we look at here is the fact that the interest rate, we're using the 6.09 interest rate that we talked about right here at the top, 30-year FHA 6.09. Okay? And we're doing a 30-year fixed, assuming that you started this mortgage on around the month of August. Homeowner insurance is 4,000. Keep in mind, home insurance changes. It varies per property, per area, all of that. So many different factors that goes into it. I can do a complete different video about that. Same tax number that we talked about, 6,420. Last but not least, the HOA, right? We got the HOA involved in there. And then at the very top right, you see what your payments will be for this property. You see that principal and interest, this is the funny part, really. You see principal and interest is $3,306.72. Okay, all right. We look at taxes, 535. They obviously divided that into the 12. And then we have insurance, which is $333. But most importantly, though, look at your total payments. It's $4,199, right? And now when you look at that little graph at the bottom, this is where you really kind of see where your money's going. You see that your interest is literally $2,772, bro. Yeah, $2,772 is literally going towards interest. Okay. And then most importantly, you got your taxes, we have your principal. And so there's another thing you can do also to lower your payments or pay off your property quicker. But anyway, for the sake of this example, this is what you would pay for this property right here if you were to purchase with the interest rates at what they're at. Okay, now let's look at another example. This is the same exact house, but let's look at it when interest rates were right around that 7.3% range back, in the last few months or the first parts of the year, right? Because we were seeing interest rate around that 7.3. It was just chilling around 7.3, just on sport mode, just cruising. So only difference that changed in this example is the interest rate at 7.3%. And as you can see at the very top right, obviously, you're paying more money in interest, $3,744 instead of what we saw last time, $3,033 and some change. But most importantly, when you look at the breakdown, you'll see that your total payments is $4,638. What does that even mean? All that means is you're paying anywhere between $400 to $500 more because of the interest rate. Now, keep in mind though, properties that have insurance that are, depending on the condition of the property, insurance might be less, it might be more. Some properties in a different area might have lower taxes. Some properties may not even have HOAs. So all of these numbers fluctuate. But the most important part that you want to take away from this video is when interest rates goes up, your payment goes up. When interest rates go down, your payment goes down. So the question is left to be said is it really worth it? So do me a favor, like, comment, subscribe, and let me know if you think it is worth it. Deuce.